As the glowing ticker on our trading terminals flashes around the $3.32 mark, retail forums and financial media algorithms are missing the forest for the trees when it comes to Keel Infrastructure Corp. Trading under the ticker KEEL on both the NASDAQ and the Toronto Stock Exchange, this former crypto mining pioneer, having formally transitioned from bit farms into an elite powerhouse of high-performance computing and grid-level assets, is caught in a massive market mispricing. Standard retail sentiment treats Keel as a lagging crypto proxy tied entirely to the daily volatility of digital assets. Yet behind this superficial wrapper lies a profound structural reality that the mainstream consensus completely overlooks: the physical, non-negotiable bottleneck of grid interconnect capacity and high-voltage power rights in North America. While retail investors stare blindly at short-term price fluctuations on mobile apps, institutional smart money understands a fundamental law of the modern technological epoch. Compute is no longer constrained by silicon design alone, it is throttled entirely by megawatts. Artificial intelligence workloads and high-performance computing (HPC) clusters demand an unprecedented continuous wall of electricity. Building a multi-gigawatt data center footprint from scratch today takes years of regulatory hurdles, environmental impact studies, and multi-year transmission queue wait times. Keel possesses what Wall Street fails to price into its current valuation: a massive pre-secured pipeline of approximately 2.2 gigawatts, with established grid interconnections already baked into the physical infrastructure across Tier 1 power markets in Pennsylvania, Washington State, and Quebec. This is not merely a collection of legacy sheds, it is a strategic portfolio of power-dense real estate sitting directly on top of vital substation access, transforming with the market prices as a speculative commodity play into an indispensable land and power bank for the hyperscalers of tomorrow. Beneath the surface of daily trading volumes, a classic institutional accumulation pattern is playing out. As macro jitters and periodic interest rate anxiety create waves of volatility, retail traders on social platforms and commission-free brokerages get routinely shaken out by minor drawdowns, panic selling their shares at the exact moment institutional heavyweights step in to quietly absorb the float. Recent insider transaction metrics underscore this silent institutional conviction, highlighted by notable insider buying over the trailing year, with zero reported open market sells, a classic telltale sign that those with the most intimate, unfiltered visibility into the company's operational roadmap believe the market price drastically undervalues its intrinsic asset base. Market makers and block traders use these low liquidity chop zones to build multi-million share positions, capitalizing on the broader market's inability to distinguish between legacy mining liabilities and modern Tier 3 data center development economics. As the narrative shifts from raw crypto hashing to high-margin artificial intelligence hosting and grid stabilization services, the supply of available shares on the open market tightens dramatically. Are you currently accumulating shares of Keel during these quiet consolidation phases, or are you sitting on the sidelines waiting for the breakout confirmation? Let us know your average cost basis in the comments below. To truly understand why Keel represents a profound asymmetric opportunity, one must strip away the outdated historical framing that categorizes the company as a simple cyclical Bitcoin miner. While legacy operations at sites like Panther Creek, Sharon, Scrubgrass, and Moses Lake originally served cryptocurrency validation, the underlying engineering architecture, massive electrical substations, high-capacity liquid cooling retrofitting potentials, and direct high-voltage transmission tie-ins is precisely what modern artificial intelligence clusters desperately crave. The company's operational scope spans key strategic power corridors, bridging low-cost hydropower in Quebec with brownfield and greenfield energy hubs across the United States. Instead of competing in the crowded, margin-compressed consumer hardware cycle, Keel's true business model is shifting into a high-value infrastructure landlord and power arbiter. By converting raw megawatt capacity into specialized high-density environments capable of housing next-generation accelerator racks, the company bypasses the multi-year bureaucratic nightmare that plagues traditional real estate developers trying to secure power allocation from regional transmission organizations. The market is mistakenly valuing Keel on trailing earnings multiples derived from legacy crypto output rather than forward-looking contracted lease values for artificial intelligence and high-performance computing infrastructure, creating a massive valuation disconnect. Looking out over the multi-year horizon, the structural catalysts lining up for Keel are nothing short of transformative. As mega-cap tech giants exhaust available power supplies in traditional hubs like Northern Virginia and Silicon Valley, they are aggressively forced outward into secondary and tertiary grids where pre-established interconnections already exist, making Keel's 2.2 gigawatt development pipeline an immensely valuable acquisition or long-term leasing target. The technological gatekeeper positioning that the company enjoys stems directly from its ability to deliver turnkey power solutions faster than any greenfield competitor can possibly permit and construct a new substation. Naturally, risks remain. Capital expenditure requirements for aggressive data center buildouts are immense. Potential regulatory shifts regarding grid usage and environmental compliance require constant navigation, and exposure to broader macroeconomic financing costs can pressure near-term valuations. However, these risks are already heavily baked into the current sub-$4 share price, offering an exceptional risk-reward asymmetry for patient capital. Looking past the short-term price noise and understanding the physics-driven realities of the power bottleneck reveals that Keel is not just riding a trend, it is anchoring the physical foundation upon which the next decade of digital compute will be built.